The balance sheet is a statement that shows what the company owns and owes. It is a snapshot of a firm's financials at a certain date. Officially, we call it a statement of financial position, which is simply an alternative way to refer to that report. Okay, so how do we prepare the balance sheet budget? To do that, we will divide the process into 3 simple steps. First, you need to find out the major line items to be projected. After that, you must decide on the end period dates, and the third and final step is to work out the estimates. Let's now take a closer look at each of them separately. All right. When it comes to building a projected balance sheet, you should make sure that you include 3 major elements. The first one is the company's assets. These are resources controlled by the entity as a result of past events that are expected to bring future economic benefits. The second section is liabilities, which illustrates the current obligations of a company arising from past events and business transactions. The settlement of these obligations is expected to result in a future outflow of economic benefits from the entity. And finally, we pick up on the equity section. It merely displays the owner's residual interest in the company. As such, the equity amount equals the difference between total assets and total liabilities. Here comes the tricky part. The total assets figure in the balance sheet should always equal the sum of total liabilities and owner's equity. This is the basic accounting equation. It is valid for every single set of financial statements out there. The relationship could also be summarized in a slightly different way. If we say that the left-hand side reflects the resources that will be controlled by a company or its assets, then the right-hand side shows how it will finance these resources. So, firms can raise funds for their operations by incurring liabilities to external and internal stakeholders, or by increasing owners' share in the business. This is an important relationship to remember when planning your budget. Altogether, these 3 components are the backbone of your projections. You should put much thought into each of the sections and have them reflect the company's goals accurately. Having specified the budget elements, you can now decide on the period of time you wish to project for. In that regard, you should be mindful that, projected or not, the balance sheet always pertains to a specific point in time. All right. Remember ABC Corporation? Its statement of financial position is prepared as at 31st of December each year, so we say that the balance sheet date is December 31st. In practice, the end period date of your projected statement does not necessarily have to be the same as the firm's financial year end. It can vary depending on your budget, horizon, and goals. Okay. Let's take a step back and look at the 3 major classes we've included in the report again. More specifically, we will delve into the subtotals in each section. Here, we divide the items into current and non-current assets, as well as current and non-current liabilities. There must be a reason for such a distinction. Yes, there is. It is fundamental for you to understand this classification right from the start. The simplest way to differentiate between current and non-current items in the balance sheet is to set a threshold of 1 year after the balance sheet date. This is how it works in practice. If assets are primarily held for trading or are expected to be sold, used, or otherwise realized in cash within 1 year, they are labeled as current assets. Inventory, trade receivables, cash, and cash equivalents are among the most common current assets lines in every statement of financial position. For instance, if receivables from clients are expected to be collected on 30th of June next year, then we report them as trade receivables in the current assets section. To make proper assumptions about the expected amount of current assets, we should dig deeper into the firm's customer agreements, financial stats, and inventory policies. So far, so good. Did you notice that we may also need to include a trade receivables line in the non-current assets section? Why is that? That's right. Some receivables may be overdue or may be scheduled for receipt later than 31st of December next year, and that's longer than the 1-year threshold. In short, assets that are expected to be used for a longer period are defined as non-current, long-term, or long-lived assets. Common examples are property, plant, and equipment owned by the company, intangible assets, or deferred tax assets. As such, it is your job to find out what are the expected non-current assets and how much they will account for in the given period. Okay. Similarly, liabilities to be settled within a year after the reporting date are classified as current liabilities. Can you think of some examples? Trade payables, of course. Companies usually pay their suppliers in 30 to 90 days, depending on the specific agreements. Even though other payment periods may apply, they are usually shorter than 1 year. That's why trade payables will always be included in the current liabilities section of the budgeted balance sheet. Of course, the total amount outstanding largely depends on the firm's volume of purchases from suppliers and the respective credits it might get. Nice. What else does this subcategory cover? Current income tax payable is normally due 3 months after the balance sheet date, and you will find it in this section too. So are the borrowings due within the next 12 months. Looking at the respective loan contracts and payment schedules, you will be able to estimate these items. Okay. Further down the line, there are non-current liabilities. These are obligations expected to be settled after more than 1 year of the balance sheet date. Some of the common items you will find in this section are long-term borrowings, deferred tax liabilities, and provisions for retirement benefit obligations. Finally, we need to balance up the balance sheet by estimating the expected owner's equity. It is affected by all the transactions with shareholders, such as the issuance of share capital, distribution of dividends, or profit accumulation in the retained earnings account. More on that later in the course. Excellent. Don't forget that the sum of total equity and liabilities should always reconcile to total assets. This stands not only for a firm's historical balance sheet, but also for its predicted statement of financial position.